You are listening to Mining Stock Education.
Welcome back to Mining Stock Education. In today's show, you're going to hear my monthly chat with Brian Leni, a co-host of MSE, as well as the newsletter writer and editor at JuniorStockReview.com. I'm Bill Powers. It's Mining Stock Education, and Brian and I have been having candid junior mining chats offline, non-recorded, for many years now, and we decided to bring some of these chats online with the record button on about once a month on the show. And do you agree with us? Do you not agree with us? Let us know in the comments. Perhaps some of the things we talk about will give you new things to think about as a junior mining speculator, or help you think about it differently. And if you don't agree with us, that's good too, because then you can think through your rationale and your approach to this sector. Brian, thanks for coming on and chatting with me today. And the topic of discussion I'd like to start off with is Found Gold. As a company, historically, and also their new resource estimate, they had about a 2 million ounce gold resource, high grade, near surface in Newfoundland put out. It was underwhelming, to say the least. The stock traded over $13 Canadian some years ago, and I think it hit like 140 or 150 a share on the news, trading down like 35% in a day or thereabouts. So I want to get your analysis of that as a valuation. But in our last talk last month, you talked about promo stocks. And the reason why I avoided Found Gold from the beginning and didn't invest was because I profiled it more as a promo stock. And you can still make money on promo stocks. You could buy it at $4 and sell it at $12. But part of what went into my analysis is that as you had Colin Cattell as the leader, he's known as a good stock promoter in the sector. He owned about 35% and I believe about 45% fully diluted at the time of the discovery. And then he is in charge of 3 companies. And I'm just going to recite some numbers where he, over the last few years, took full-time salaries from 3 companies simultaneously. Found Gold, $518,000 cash, both in 2023 and 2024. Palisades Gold Corp, ending in September 23, $330,000 cash and a total compensation of $7.2 million when factoring in stock compensation. And then also Nevada King Gold, an exploration company in Nevada. In 2024, he was paid $370,000 via a company he controlled, and in 2023, he was paid $1.3 million via Nevada King via a company he controlled. So all of that money is being taken in for full-time work, simultaneously. And that kind of exemplifies my point, in that he's taking full-time salaries from 3 companies at the same time. I'll never invest with somebody like that. And all I have to do, Brian, is look at myself. I've been involved in multiple things at multiple times. And when I do, I can't stay focused. I sit down like early on a Saturday morning and I come up with a list of what I need to do on my farm, what I need to do with this entity, this entity, this entity. And you say, where do I even start? And you start one, and then you think about what you got to do with the other one, and then you're conflicted. Do I go work on that, or do I stay working on what I'm working at now? You can't be the leader of 3 companies at the same time. What are your thoughts?
Well, I completely agree. All those things that you outlined are reasons why I avoided it at first too. That headline drill result, I can remember back seeing. I forget the numbers off the top. What they were marketing around it was a pretty sexy drill hole, and I think the biggest point for me is the market cap coming out of, or in their RTO, I believe it was an RTO, not an IPO, was super high. I think it was over $100 million, and something like that. Even though the whole was excellent, is something that kept me away early on too. And then my connections to Newfoundland and some of the people, the geologists there, they said that it's highly complex, that area that they're in, and it's going to take a lot of drilling for them to fully understand this and for the market to understand it. So for me, it was an avoid right off the hop, and I just right from the perspective that I thought it was expensive, and outside of what it became in that promotional juggernaut, because it went, like, I think that thing was almost up to a $2 billion market cap at one point, and that became really easy for me to avoid. When you look at a $2 billion market cap today, and you think of what a company needs, besides the discovery plays that can sort of jump out at you in terms of market caps, but a realistic $2 billion market cap, you're talking about something that has to be over 10 million ounces for you to get a valuation like that. And so for me, that's like the classic situation to absolutely avoid, especially when it's in conjunction with large marketing programs and such. And the CEO being on multiple, or I don't even know if he was the CEO the whole time, because he was a part of the management group, but on the CEO of Nevada King and something else. Because there was another guy, I'm pretty sure that was the actual CEO of Found Gold. But people that are involved in multiple deals, as you say, cannot put all their attention into one. And I think as an investor, this is something you need to look for, is, that shareholder and management need to be aligned, not only in cost of capital, but also the direction and the amount of attention that a company is getting. And so you can't be spread that thin, especially if you're making that kind of money. You deserve to be focused on one thing. The other sort of side to this, and it was a conversation that you were privy to too, and a friend said to us, he said, when you get into these promotional ramp ups, a lot of companies will try to pick promotional marketing programs to catch market attention, to capitalize on whatever market's out there, and it's the best way to get your market cap up, invest your cost of capital or your cost of cash to raise for the cheapest amount. So what I'm trying to say is that there's a reason why companies will go into promotional streams, and they'll try to do that to get their market cap up so they can raise money at the cheapest cost. Promotion is not a bad thing, and that's not the point, I don't think, of what either of us are trying to say. And you need promotion, because vice versa, I've seen promotion or lack of promotion on some companies, and you think, why isn't the company getting a proper valuation from the market? And it's because they're doing nothing, or what they're doing is very inept in terms of capturing attention and the market recognizing it. So promotion is important, and you need to be able to do it. And I think you need to pick the best sources, or and you can look at what best means from a number of perspectives, but to get proper valuation. The thing is it can get crazy, and the amount of money you spend on getting promotion can get out of hand. If you're putting too much money or more money into promotion than you are into the ground, then this can be a huge problem. And this is why, I've heard Rick talk about this 20% or 25% of G&A spend versus what's going into the ground as kind of a moniker for overspend or underspend. And I would probably somewhat agree, but I think that's how people should sort of gauge promotion in terms of its effectiveness, whether a story is solely promotional or they're actually, a good company that's spending money properly to get a good valuation, because I think that's just as important. And so the complexity is that investors, there's not just an easy answer in terms of looking at something and saying, oh, I see this company everywhere, therefore they're a promotional company. You have to do the work. You have to go in the background of how these people are spending it, how much are going to salaries, how much are going to the marketing each month, and compare that to what they're putting in the ground. A company like NFG it's sort of interesting because these guys did a lot of drilling.
600,000 meters, I believe.
Yeah, and this is significant, and it was significant because it goes back to what that geologist told me early on, that they needed to. The complexity of the structures and the mineralization dictated that you're going to have to do probably 20, 25 meter step outs to really understand the pinches and swells of the structure, and you need to fully understand it. So all what I'm trying to say is I do think that there is definitely a tendency to be more on the promotional side. But some of it can be justified to a point when you have to do major drill programs, you have to do these sorts of things. Having the best cost of capital is the way to do it. But as an investor, you need to be wary of market caps, evaluations, and when it just gets insane. You can't have a pre-resource pre-resource company, I don't think, with over $1 billion market cap, unless it is so obvious that this mineralization or the system that they've identified, fits it, that it is going to be, again, $1 billion. If you look at a pre-resource company, you're talking about probably 10 million ounces for you to justify that sort of, or between 5 and 10 million, depends on how you want to look at it.
Marathon Gold's the same island. Marathon Gold's Valentine project, right? That was bought out by Calibre, which now Equinox is gonna own. So if let's say they discover something, they're only at 2 million ounces, but if they get above 10, and it's the string of pearls concept like Marathon had there on the island, would it be worth? What is that going to be worth? Because I think we're still at we're at a multi-$100 million market cap right now. What could something like that be worth at the PEA stage, which still would take a lot of money to get there?
Sure. Well, from my perspective, it's more complex. I don't think you can it's never apples to apples, but Valentine Lake, that's a really good comparison. It's basically right along that, almost the same belt. I think Valentine's a little bit further west than Keats is, but it is a good comparison because you're right. It is sort of these multiple deposits, basically at surface, that are going to be open pitted. The thing is, and I still look at around 2 million ounces with the open pittable at a $300-ish million market cap, I would without even looking at it, and I haven't, I'll admit that, but without even looking at it, I would say they're probably still overvalued. and that's just the gist of it. The other side is I can think of a number of companies that have more ounces, that have even more than a PEA, I would say, on the verge of having a PFS, with close to 5 million ounces, and the market caps probably about 2/3 or closer to a half of what NFG is. So you have to hold that company at this valuation right now, in my opinion. I think you're not even talking about fair value. I would say it's still a little bit overvalued. And then, so you have to be pretty optimistic about what's going to happen there. And the whole idea of them processing stuff at Pine Cove, like, okay, that's great. But you're a long ways away from understanding the economics of that. And so again, pre-resource, pre-PEA, still there's a lot of valuation in there that I think they're still getting on the high side.
So a common retail argument would be like, well, Eric Sprott still backs it. He still likes it. He owns about 19% of the company. He's written checks at share prices higher than it is now. And my quick response would be, but Eric's also said he owns hundreds of mining companies at the same time. And also, whether this is successful or not, it's not going to change his life. Whereas if you put 10 or 20 or 30 or 50 grand into it, that could be very meaningful for you and me. For him, not so much with his net worth. And it seems like Eric also talks about the upside, and perhaps, at least from my vantage point, doesn't factor in all the risks, at least in podcast format, when he talks about certain stocks that he owns.
I would say you're absolutely right on all those points. I think Eric's approach is that of someone who's a multi-millionaire or billionaire. I don't know what he actually is. But when you have that amount of money and you have a portfolio of that size, you can take such a longer view of things and have probably more a perma-bulls type goal or in mind, goal that...
Because your risk is spread out over 200 issuers.
Well, that and you're really, any of these positions, like whatever that 19.9%, let's say it's worth $10 million. Well, if you have a $500 million portfolio, it's still nothing, like 1 or 2%. Why don't you say like the impact of that on your portfolio is sort of negligible, and that does diversification. It does have a portion of that, like what you're saying. Like if you have 100 companies and $100 million, it doesn't really matter what any one of them do. Your real big moves are probably in a bull market sort of scenario, and in that case, you're probably okay. And again, when you also own that size of a company, you're not exiting via the market. You're exiting via an acquisition or production or like something like this. That's your exit from the story. You're not going to be selling that position out into the market over a period of time. There's just not enough volume in this sort of market. So I think you take a position like that as a kind of sort of a perma bull and being sort of neutral, and it's easy to. And that's why I think it's like, it's great to see. I was quite surprised and happy to see Eric come out at PDAC and do an interview. He's done a couple now in the last few weeks, and I think it's great to see. I think it's good for the market to have somebody that speaks so positively about it and keeps people optimistic about what's ahead. The other side to it is it can be super dangerous, I think, for a regular retail investor to sort of take his mentality. My experience has been that you can't count on metal price for investment in a junior company, meaning you can't take silver going to $100 and then permeate that into investment into a silver company and then count on that happening for you to make money. And I think that might be the tendency for investors that sort of listen to some of the things that he talks about, because it does kind of rile up all the greed in everybody when you talk about $100 silver, $200 silver, or $5,000 or $10,000 gold. That the greed that's people get is through the roof, and that's what brings people in the sector, which we need. But it comes with that stipulation that metal price is just one way you can lose money in a junior, and you can't ever forget that. General retail cannot take the same approach as Eric. But he has been so important to the sector, as Dave Lotan in his Red Cloud presentation showed a couple of years ago. He probably single-handedly held the sector up by 2018, 2019.
Via the Kirkland Lake profits, right?
Yeah.
Rotating that back into juniors.
Yeah. And so it was an amazing thing. And for people in the sector, he's what really kept it alive. But, for the general retail guy, I wouldn't say that his approach is necessarily something you want to copy.
So on this idea of management receiving multiple salaries from multiple issuers simultaneously, I just want to dig into this just a little more, Brian, because so many people in the sector, they're involved in so many companies at the same time. So the question I have is, if your name is an advisor with these companies, with two companies, and you're not receiving compensation from those two companies, but you're working for two other, one is a paid advisor, one is the lead executive, where's the cutoff line for I might think about investing in the company in which this person is the lead executive when they're involved in so many other things? Because I've heard the argument on the executive side. Well, I love all my children and I'm just able to do it. Kind of just trust me. And I shared up front in this show, I don't think you can, because I can't do it. I know that when I've been involved in too many things at the same time, not only do I have my wife saying you need to cut back and choose what you want to focus on, I know that I'm not as productive on the one thing. And for the sake of shareholders, you need to be productive on the one thing. The counter argument would be, well, what happens if that issuer can't pay them what they're worth or what we need? If we get 60% of this guy's attention at $100,000, isn't that better than having somebody of lesser quality at 150? That could perhaps be an argument. So I called you last week. I was presented with a stock. They said, Bill, this is a good project at a low market cap. And he said, the person who presented it told me, but he's involved in two jobs. He's paid as a CEO here and a CEO there, just so you know up front. I'm like, okay, I call you. And you said, Bill, oh yeah, and he was taking money from a third company last year until they let him go in this summer. I was like, oh, 3 companies at one time? No, thank you. What are your thoughts, Brian?
I can argue it from both sides. I think all those points you bring up are real. So from the side of the executive that is in multiple deals, I would say this. Maybe they could say, oh, well, one of my stories is in the northern part of Canada or somewhere in the north where they only have an exploration or development season of, let's say, 4 to 6 months. So 4 to 6 months of the year, I don't have anything else really to focus on 100%. So I can take a company that has a Nevada project or has a South American project who has the opposite season to us, and I can promote that too. And so I think, you could work through and you could say, well, maybe that works. The other thing you have to realize, though, is for companies that only have news flow 4 to 6 months of the year, is that there's nothing else happening 4 to 6 months of the year. So maybe you don't want to invest in that company. We all know how important news flow is to market attention. And there's, especially depending on the development side where you are in the curve, attention needs to be there. You've got a lot of competition, so news flow is important. The other side, again, like if you're talking, okay, well, I'm the best of the best, and so 20% of me or 30, 40% of me is better than 100% of the average Joe. Okay, again, you can decide to take that as justification, but in my experience, and I've done this, for 9 years, I don't see it. The best of the best people, you want to talk about Ross Beatty, Robert Friedland probably isn't the best guy to look at anymore, but Ross Beatty is, and you look how focused he is on Equinox, and that's a guy that's got a history of turning companies around or being contrarian in developing companies, and he's got one sole focus, and that's what he does, and he is usually successful. And so there's a number of different guys that you can look at that I would say that were at near the top, and they either tried to go multiple or they've always been singularly focused, and the singularly focused guys are always the ones that have come out on top. And there's the odd story that has somebody that's been involved in multiple deals, and of course they do it. But I would say that their impact to it was very small. And again, my experience tells me that you can't do multiple things and return that value to companies. And so that's where your focus needs to be, is on the singularly focused CEOs and management teams.
Okay, on the profile of a CEO, what are the strengths and weaknesses of having a CEO come from like a strong, more established miner corporate background? Like they've been doing the corporate, bigger company, they have an expense account, everything's paid for, they have a cushy salary, a nice office. Perhaps they don't have that entrepreneurial like pressure on them the way you would with a startup junior miner. Then they're installed as the CEO, the lead person, and a junior miner. What are some of the pros and cons? For me, I can see that mentality. A lot of times I've seen it. One company I was invested in, that they brought someone in from a major miner into a junior development exploration company, and they were making upwards of like high 300s, plus bonus compensation. My experience is that some of those people that come from that corporate world, they kind of have a chip on their shoulder in terms of marketing. Like, I'm above this marketing. I don't need to be as aggressive or as entrepreneurial in telling the story and getting the message out there. Also, there can be, especially when you're paid a nice rate going on from the get-go, you and I know what it's like to start something from zero. It's like, I get paid if I'm successful. So that causes me, when I get up, to work very hard with that vision. Otherwise, I'm just wasting my time, my money. I'm going to give nothing to my family in return for it. But if you have a cushy salary and an expense account to start off with, at least until the $10 million in the till runs out and you have to go raise again. So I've seen executives also be wasteful. And when another company I invested in, he came from a big miner, blew through $20 million in a year with not much to show for it. And so I was very unimpressed with that. What are some of your thoughts, Brian? I lifted up the negatives there.
Well, then I'll talk about the positives. And I think it very much depends on what stage of development the company's in. Exploration is so much different than a developer, meaning like an existing resource base and then, perpetuating the company through PEA, PFS, and FS. I think most ideally, probably a corporate type mentality is best for those developer type companies. Not only understanding what a senior company miner is looking for, but probably most important is the network effect. I think you would agree with me that network is probably the biggest factor in terms of information, but just connections into other deals that an investor especially could have. But I totally see it on the company side of things where, they've already got to step in with Agnico Eagle or Newmont or Barrick. and they're able to construct a JV deal or whatever they're trying to do, or an equity placement, just because of that, where they're from, and that experience and reputation they have. The other side is, I think, the professionalism. The corporates that I've met that have made that transition from a senior to a junior, very professional. The way that they handle corporate decks, the way they handle investors, the way they structure their investor relations. All these things are very structured and professional, and I appreciate that side of things. So I think, depending on what type of company it is, what they're coming from, what their role was, were they a finance guy, were they a technical guy, a mine builder, were they on the exploration side, whatever they were, it can be a positive depending on what they're taking on and sort of what their vision is. And I think those things that you said are definitely risk factors, such as the budgets, where if you've never raised money before, or you've never been on the hook for an actual budget outside of a company that has a constant revenue stream, I think that's a huge risk. And that can be a huge disconnect between how they operate. And then the salaries thing is a definite risk too. These guys have had a very cushy, I shouldn't say cushy, but they've always had a paycheck coming in, and it's probably been a very good paycheck for what they've done. And as such, they pay themselves and probably the rest of their team very well, instead of it being more incentive based or option based. And so again, that does tie into the overall budget, but I would say that is a risk, and probably where they do fail most often.
Yeah, so you have to look at the incentives is what we're talking about here, right? Like, what's going to motivate that executive coming from the corporate world? Because one told me in the conversation, he said, Bill, I could make a lot of money doing what I did. And he told me it was a cushy job. He said, I had an expense count. I traveled the world on the company dime. Like, now I'm, struggling to raise money. I get paid a lot less, and I'm only going to make money via shares if this thing is successful. So I guess that's what you want to look for. And you want to look for someone that's been trained, like been paid to get trained within the larger corporate structure, but then they have that entrepreneurial spirit and ambition to really make a name for themselves and make some big bucks leading a junior. Would that be right?
Absolutely. The incentive and alignment is always probably where you start, no matter what the background of the person is. And the more incentive there is for them to be successful with that junior, the more aligned they are with you. And so that's where you start. And sort of the background, where they come from, and how they tie that into the story and the development of the story moving forward, is sort of how everything gets encapsulated, and probably where you need to make your decision. Just like anything else, as an investor or, as a company person, you've all these different factors that are sort of out there, and it's how you bring them all together to make a decision. And that's what separates you as a successful investor or as a CEO, I think, and how you can bring everything together into a vision and execute.
So you have to, when someone's talking about the sector, you want to understand the framework from which they're talking about it. You want to understand how they view their portfolio in terms of allocation and things like that. You mentioned that in regards to our conversation about Eric Sprott, to where he's literally in so many miners that even when he takes a 10% or a 19.9% in some of these junior miners, in terms of his overall perspective, it may just be, like you said, 0.5% or 1% of his portfolio. So with that being said, what are some of the things that you've reflected on in the last month about your own portfolio allocation and how you manage your portfolio?
I think, the biggest thing about portfolio allocation has come from a really super hard set of lessons I've had to learn. 2022, 2023 were terrible years in terms of losses. And I had to endure those losses to sort of understand better how to properly allocate a portfolio as a reflection of myself. I think that's the key component, is you have to understand yourself, how you operate, what your risk level is, what's your knowledge level, and apply all those things in terms of how you're going to construct your portfolio. One of the biggest differences that, if you looked at my portfolio or the Junior Stock Review Premium portfolio in the last, 2024, and compared to the prior 2 years, was how I approached exploration. I very much stepped away from sole exploration companies and focused in on prospect generation focused companies with that business model, not buying the waterfront, so to speak, but isolating certain companies that fit my criteria and invest in those. And that's from a risk perspective. And also the indicative of the market that we're in, where the developers or the stories that were sort of in that bottom part of the Lassonde curve weren't necessarily garnering any attention. So exploration can sort of pay you no matter where you are in the curve of the market cycle, or because they're on the exploration side, they're on the proper side of the Lassonde curve, so to speak. And that's what I wanted to take advantage of, and especially in a couple of cases where the underlying value of those companies wasn't being recognized. The second part to that is looking at the developers and saying, okay, well, if I know this company extraordinarily well, I know where they are, where they're going, and I know what that delta between price and value is. I would rather over allocate, meaning probably take more than a 10% position in my portfolio in that company I know really well, that's most likely has a high probability of doubling, than doing your general 5 or 10% and kind of moving on. And so in a couple of situations, I moved, into plus 10% categories, like 12, 13, 14% into a developer. So if they doubled, that would, that's super meaningful to my position. And that's in contrast to maybe a prospect generator that had a 2 or 3% allocation that might go 4 or 5 times if they're successful, or maybe you lose it all if nothing is happening, and as some of the juniors can go. So the contrast is, if you know the company really well, you put the money in at a higher percentage, and that doubling of that, which is not as big or not as sexy as a 4 or 5 bagger, but can have the same effect to your portfolio if you've allocated the right percentages and you have that mentality of what you're looking at.
How big will you allow it to be on a percentage basis within your portfolio? 20%? Could you let it grow to 30, 40% one position?
I'm more inclined to even go higher these days.
And what changed, Brian? What changed?
I think it's those lessons that I learned. Like, I think the money that I did lose, and then the success that I have had in 2024, and the more that I understand about what makes a company successful, and looking for those things there's nothing for sure in this business. You don't have 100% probability, I don't think, in anything, maybe in life too. But there's ones where you have, let's say, that 70, 80%, 90, maybe 90% probability. And that's going to be partially a subjective way you come up with that probability of happening. But if you have that high of a probability of doubling your money, why wouldn't you go a higher percentage of your portfolio? And again, I'm not trying to promote people going crazy and putting all their eggs in one basket. For the general retail guy, again, we're talking of like the Eric Sprott approach. That doesn't mean the Brian Leni approach is right for you. And I'm just saying, from my personal experience, is that if I'm pretty confident in the outcome, and I'd say it's like that, not a guarantee, but a high probability of a 40% gain, 50% gain, 100% gain, I'm more apt to put, let's say, 10, 15, 20, 25%, maybe even a higher percentage, depending on what the situation is. But you still know that delta, or that probability of it not happening still exists, and you have to be comfortable with that. But what's the downside if you are wrong? And again, it's how you construct your portfolio as such. And it also has to do with buying too. So I'm much more willing to buy at a higher price than my original position.
Because you buy in tranches, for those that don't know.
Right.
Yeah.
Yeah, right. And if the story is going around, because it's always comparison to the delta between price and value. So if the delta is, if the value in the company is still going up, and the delta between the price of the underlying value and the market cap is still present, just because I bought the stock at 10 cents and now it's 20 cents, but the upside potential is even better, or maybe the risk has been reduced. That's the other side to it. Maybe the delta isn't the same, but maybe the risk is incredibly different. Like, this is like going from a PEA to a PFS. I think what gets lost is how big of a difference there is between a PEA and a PFS. The confidence level in a PFS is so much higher. The constraints that are put on the ore body the engineering that's done on the metallurgical process, all those things are done to such a higher degree between a PEA and a PFS that the risk has been reduced. And so while the market seemingly doesn't always care, and maybe this is a liquidity event, which often it is, but as an investor, the risk has been greatly reduced. So if you see a market opening up and these guys have other parts of the news flow, or if you're entering like a bull market phase, these companies can be huge, gains to your portfolio profits, versus the exploration companies that, have much higher risk profiles. The sort of de-risking is more ambiguous. And that's why I think, I've been super successful concentrating on developers, while most of the market probably would say you got to be in exploration to make any money. And I would say that's not always the case. And again, if you're smart about how you allocate, you can sort of beat the market in a sense. Again, if you think about it and have the right mindset.
Okay, so you take a bigger position in a company, 6 figures or multi-6 figures to start off with, and you're up 3 times. So now you have to offload, let's just say, a $600,000 position. Do you agree with Rick Rule when he says you have to take the liquidity when it's given to you? I sell when the market makes it easy to sell. I buy when the market makes it easy to buy, is what he says. How do you approach offloading a position, a substantial size position in a company that maybe only trades 100,000 shares total a day?
I think first you have to start off, before you even took that position, before it 3-bagged, you probably should have an idea or like a more long-term view of how that stock is going to sort of play out. Whether you're hitting a bull market, what piece of news has sort of driven it to 3-bag, and what it looks like moving forward. There's going to be some companies that I think that you're going to get that 3-bag, and you have to be more careful about selling earlier. So you can't necessarily wait until that thing goes multiples, depending on what that risk is. What I mean is probably on the exploration side, you probably have to, unless you really understand what you're dealing with in terms of that ore body, what the probabilities of it getting bigger or just holding up as they expand out or go deeper, you probably have to be selling along the way. And so you can't just get to 3-bag and then decide, I got to unload 100 grand or whatever that is, or 30% of my position, because the risk you're taking might be that much higher. The other point to what Rick was, I think that he's trying to say, is that when liquidity is given to you, you have to take it. And this even ties in with the promotional things. And what I would say is, what you also have to be careful with promotional companies is usually big spends on promotion are linked to somebody that's got a big position in the company that are probably close with management in some shape or form. You take whatever you want from that, and they've incentivized the company, or not incentivized, but they've pushed the company, hey, you need to go hire such and such, we need some volume, I need to bring my position down. And so that's the other thing you have to be careful of, and that's why often big promotions go up like this, like a mountain, and then they fall right back down. And so that market capture that they'll probably tell you that they're trying to capture was really just a liquidity moment for a big investor or somebody they were trying to create.
It's functioning at the market facility too, with like a supportive investor might say, hey, I'm willing to do a financing, but I own too much of your stock already. So if you do a little marketing, I'll sell into it, and the proceeds from my selling, I'll put into the next financing. So there's that. So which is functioning at the market facility, which the company doesn't need to announce.
Right. But I'm just saying, I'm just giving perspective on what the promotional side is there for. It's to provide liquidity at certain moments, and the reasoning why can vary, from something that's more nefarious to something, as you say, which still, depending on how you look at it, may be good or bad. It depends on the situation. But liquidity matters. And again, the larger your position size, the more it matters. And again, for general retail, I'm not sure that it matters as much, because we're probably not talking about enough volume for it to matter on a whole. But as you get to be a bigger investor, liquidity becomes probably the bigger question, or how you're going to get out of the stock becomes the bigger question. That ties in with the Sprott thing. When you're taking 9.9 or you're taking 19.9% of a company, you're not, especially because you have to tell the market what your buys and your sells. You're not liquidating that position into the junior market unless it's a ripping bull market and you've got that liquidity. You've got a longer term M&A strategy, or you think this thing's actually going to production, and that's sort of the end game. For the general retail guy, you can play those liquidity moments, or those as Jacques, who we had on the show a couple of weeks back, talks
Mini
about
bubbles.
Yeah, and especially if those mini bubbles are associated with moments where there's no news flow, those are probably times to take some money off the table. And that doesn't mean, like, let's say you sell 10% of the position. Those mini bubbles, depending on how you want to look what mini bubble is, but most likely these things will go up and they'll come right back down, or they'll come back, halfway in between where they started and where they went. And then so you can just rebuy that 10% and you made that differential. So again, it's all in your strategy, all in how you see the market. But again, you need to understand yourself. What is your strategy, and try to stick to it. Trying to do too many things and copy different people is not the way to do it, because we all have different different portfolio sizes, risk tolerances, and knowledge. And so you need to find what fits you and how you're going to play those mini bubbles, or you're going to think more long term, or whatever it is you decide is best for you.
And you need a balance between the long-term thinking, like how Rick says, most of his 10 baggers took 5 years to get there, right? So that's a truth on the one hand. On the other hand, if you don't want to be a bag holder, you need to recognize and profit from the mini bubbles, like Jacques talks about in his book, The Art of Investing in Junior Mining.
Absolutely.
Any other thoughts, Brian, as we conclude from the past month?
Maybe. Well, no, I've got a question for you, because
Sure.
it's something that's been on my mind. It was another company that I was considering, and it sort of ties in with our conversation that we had just after PDAC. It has to do with mine construction, and what your view is on juniors that are, let's say they're at that PFS or feasibility level study, and the next step sort of is construction. What do you think about junior companies that promote the fact that they're going to build the mine themselves?
So I think it has to be believable. Like, if you want the highest valuation for a takeout, if you're a developer, like a late stage developer, and you're saying, am I going to finance this to try to bring it in production, or can I get my share price as high as possible, which marketing factors into that. Part of marketing is believability, to get my share price as high as I can. So then when I negotiate with the majors that could potentially buy me, I have a higher starting point for the negotiation. So I think the general posture has to be, I'm going to bring this into production. I think that you can give yourself some negotiating leverage, give it away, if you just say, I want to sell this thing, I want to sell this thing, I want to sell this thing. Because what happened if there's no buyer there? Then you're just a stranded company, and the market's going to penalize you for that. It's going to sell off. As you know, a former sponsor, Hayadan, with Osino Resources, they discovered a gold deposit in Namibia. They brought that through the economic studies, recently sold it to a Chinese company. And Haya is an engineer, right? So he has experience constructing and, visualizing a mine build. So you have a leader like that. If they say, I'm going to press in towards the build, I'm going to build this unless I get the buyout price I want. I think that's believable with a leader like him. But if you get a finance guy that was a CFO and he's the leader of the team, if you're going to convince the market that, hey, we're going to build this thing ourselves, I think you need to bring in some external experts into the company, or partner with somebody, or form a JV or something for it to be believable. Hey, we're going to build this thing. Even if your intention or your desire would be not to build the thing, but to sell it, but I need to sell it at a higher price. So I need to get the market to believe that I'm going to build it.
Right. Yeah, I agree with all those points. I think the only other conclusion I came to is the value of that project that they're saying they're going to develop or not developed. Obviously, if the project is at the top, like a tier 1 project, I don't think that the company needs to necessarily say that they're going to build it. I think it's feasible for them to take the approach where they say, we're not mine builders. We're going to sell this thing. And if it's a top tier project, it will get bought out. The history has shown that those tier 1 deposits just don't sit around for very long, and there's enough competition out there, probably depending on what jurisdiction it's in, for that to be real. Otherwise, I think you're right. Those points make a lot of sense. It's those in-betweeners that caused me to have more thought in how to approach them. And more often than not, I've just, I'll sit on the sidelines and see how things go. And that's maybe how I'll approach this other company.
And that was my question to you last time we chatted on the show was, do you invest after the finance package is announced, right? Or before the finance package? These are some good questions.
Yeah, well, the financing is such a big question these days, how they're going to do it, how it's going to be allocated, how it fits in with the company valuation, because especially if they're doing more equity or a royalty, it can change everything in terms of that valuation and what it looks like and its prospectivity in terms of investing in it or not. So yeah, waiting to see what those packages look like. And the Lassonde curve or that Lassonde curve type mentality sort of fits that too. That these guys need to secure cash and sort of be in the construction before the market will begin to recognize their value. And if you hit a bull market in amongst all that development, that can be sort of an X factor. Because I've seen a couple companies in the gold space that I took that approach with last year. And sort of missed the curve where I thought their share price would stay more level. But they really reacted to this bump up in the gold price and sort of the frothiness. And because they were, I think at probably maybe not tier one, but they were on the higher side of the projects that were out there, and their valuation, went up 200%. So that was missed. So, you have to look at that market cycle too and where you are, because it can affect how the company is valued.
Great points. If you want to learn more of Brian's companies that he invests in specifically, he shares that via his newsletter at JuniorStockReview.com. I don't have a newsletter. This is my show. It's a sponsored-based show. Never asked you for money. I don't plan on asking you for money. It's a sponsored-based show, the companies we feature. Brian, it's always good chatting with you, and thanks for chatting with me on the show today.
Thanks, Bill.